August 3, 2023, Evanston, Illinois. The air conditioning hums inside the mahogany boardroom at Magnetar Capital, overlooking the grey waters of Lake Michigan. The projector displays a financial structure that completely contradicts the basic laws of physics and finance. Private credit managers, desperate for yield in a high interest rate environment, are reviewing the legal framework for a $2.3 billion debt facility for a startup called CoreWeave. They are not lending against commercial real estate or steady cash flows. They are using 32,000 NVIDIA H100 graphics processing units as literal collateral for a massive corporate loan. It is the very first silicon mortgage. The fundamental paradox of the generative AI boom is officially born in this room. Wall Street is actively financing hyper-depreciating server components using the long-term debt instruments traditionally reserved for 30-year infrastructure assets. They are underwriting loans on hardware that has an economic half-life of 18 to 24 months. You do not issue a 30-year mortgage on a ripe banana, calculating the collateral value based on today's premium price, because in 2 short weeks, the banana is rotting. But the credit managers are pretending the banana is a skyscraper. The lead underwriter points to the long-term projection model on the screen. He tells the room, "We are effectively underwriting the compute layer of the next industrial revolution. The hardware is the new real estate. If they default on the payments, we simply repossess the chips. And the chips are highly liquid." The client, a pension fund representative, nods in total agreement. The underlying assumption built into their spreadsheet is that inference demand will massively outstrip hardware supply until at least 2028. But this is the exact moment the trap closes. The fatal blind spot is failing to account for the speed of architectural innovation, rendering this collateral entirely illiquid. To understand how tens of billions of dollars in market capitalization can vanish overnight, you have to understand the underlying mechanics of this trade. That is what we do here at Capital Curriculum. Hit the subscribe button to join the minority of investors who actually read the footnotes. Because the mainstream financial press is completely missing the catastrophic duration mismatch hiding inside these term sheets. The bankers are treating routine server maintenance as growth capital expenditure to hide massive losses. Let us break down the exact mechanism of the silicon mortgage and the massive accounting illusion making it possible. In traditional commercial real estate, if you build a concrete warehouse, it depreciates steadily over 3 decades. It is a hard asset. Data center real estate investment trusts operate under identical accounting assumptions. But AI data centers run incredibly hot. They require 30 to 50 kilowatts of power per rack, compared to just 5 to 10 kilowatts for traditional cloud computing. Because of the thermal load, the internal hardware degrades rapidly. Maintenance costs should be absolutely skyrocketing. But the executives instruct their accountants to play a high-stakes shell game. The engineering manager tells the site director, "The uninterrupted power supply battery is dead. We need an immediate replacement." The site director replies, "Log the replacement as a capacity upgrade, not a routine repair." By intentionally misclassifying the replacement of fried motherboards and dead lithium-ion batteries as growth capital expenditure rather than standard maintenance, the company perfectly hides the true cost of operating the facility. This specific accounting trick allows them to artificially inflate their adjusted funds from operations, which is the primary metric Wall Street uses. This manipulated, non-standard metric drives the stock price up to record highs, instantly triggering multi-million-dollar performance bonuses for the corporate executives. The actual cash reserves are bleeding dry to replace melted server fans and blown power units, but the public balance sheet shows record-breaking paper profits. The major auditors sign off on depreciation schedules that treat specialized, high-density cooling infrastructure as if it were poured concrete. Simultaneously, the credit rating agencies slap an investment-grade rating on the newly issued asset-backed securities. They focus entirely on the length of the regional power grid contracts, while completely ignoring the technological obsolescence of the servers generating the underlying revenue. They rate the wrapper, ignoring that the cash-generating asset inside the wrapper is rapidly expiring silicon. The blind spot is institutional, and it is fatal. The private credit markets have built a $50 billion house of cards on the assumption that NVIDIA's current generation chip will retain its premium value. But in the semiconductor industry, massive architectural leaps happen every 2 years. The new architecture is coming, and when it arrives, the collateral backing these billions in debt will become instantly illiquid. February 21st, 2024. Santa Clara, California. Inside NVIDIA corporate headquarters, the mood is totally euphoric. The fourth quarter earnings call has just concluded, and the stock is surging in after-hours trading. By morning, the company will add $277 billion in market capitalization in a single trading session. It is officially the largest single-day wealth creation event in the history of financial markets. But away from the champagne toasts in the executive suites, the internal finance team is reviewing a highly sensitive allocation ledger. They are operating a shadow structure known in the industry as round tripping. The ledger dictates exactly which server farms get the newest and most efficient chips. They are actively prioritizing shipments to neo-cloud startups like CoreWeave and Lambda Labs. They are deliberately choking off hardware supply to traditional competitors in order to artificially prop up the valuations of the specific startups NVIDIA has directly invested in. It is a completely closed loop of capital that perfectly manufactures the appearance of insatiable global demand. The massive wealth creation is actively being driven by a vendor funding its own customer base. The conversation at the allocation desk is explicit and entirely focused on protecting the corporate equity investments. The supply chain manager looks at the massive fulfillment requests and says, "Choke the traditional cloud providers, route the next 10,000 units directly to the startup we just took a $100 million equity stake in." An independent hardware analyst, observing these exact market dynamics, tells his institutional clients on a private call, they are not just selling picks and shovels during a gold rush. They own the guys holding the shovels, and they lent them the money to buy the picks in the first place. This is the auto dealer wash trade occurring on a global macroeconomic scale. Imagine a car dealership that desperately wants to show Wall Street record sales for the quarter. The dealership takes $1 million in cash and hands it to a stranger off the street. That stranger walks right back through the front doors and buys 10 cars at full sticker price. The dealership reports the transaction, their stock surges $30 million, and Wall Street completely ignores the fact that the dealership funded its own customer to create demand. The financial wireframe of this highly lucrative vendor financing loop is orchestrated through a network of opaque, special-purpose vehicles. Here is the exact flow of the cash, step by step. Step 1. Massive pension funds and massive private equity firms inject hard capital into a newly formed debt fund. Step 2. This debt fund extends a massive $2 billion loan to a neo-cloud startup. The massive loan is heavily secured by a lien on the exact graphics processing units the startup intends to purchase. Step 3. The startup takes that $2 billion and buys hardware exclusively from NVIDIA. Step 4. NVIDIA officially recognizes $2 billion in top-line revenue. Because the public market assigns NVIDIA a massive 35 times price-to-sales multiple, that $2 billion in revenue instantly adds $70 billion to NVIDIA's total market capitalization. Step 5 is the round trip. To ensure the startup can secure the initial massive loan, NVIDIA uses a tiny fraction of its massive balance sheet to make a venture capital equity investment back into the startup. The initial capital injection perfectly guarantees the multi-billion-dollar public return. The money has traveled in a perfect, unbroken circle, creating massive, phantom value at every single stop along the way. The startup secures a multi-billion-dollar private valuation to attract more venture capital. The credit fund captures massive origination fees and claims a high-yield return for their limited partners. Nvidia generates $70 billion in market capitalization out of thin air. Absolutely everyone is getting incredibly rich on paper, but the actual systemic risk is expanding like a high-pressure balloon. The special purpose vehicle now holds debt collateralized by silicon that will lose 80% of its utility value in under 3 years. Yet the actual loan duration is firmly set for 7 years. When inference demand inevitably cools down, and the startups cannot generate the hourly compute rental rates required to service the massive interest payments, they will immediately default. The debt funds will move to foreclose, only to discover they are seizing technologically obsolete server racks that literally nobody wants to buy. But for now, the music is still playing loudly, and the entire industry is moving blindly into the most aggressive phase of the massive financial illusion. It is late 2023. We are in the golden age of the data center real estate investment trust. Valuations for major facility operators like Equinix, an $80 billion global behemoth, have completely detached from fundamental reality. Inside the corporate suite, the compensation packages are directly pegged to a metric known as adjusted funds from operations per share. The internal incentive structure practically demands active accounting manipulation. If the top executives can somehow suppress the maintenance capital expenditure line item on the quarterly earnings report, they automatically trigger multi-million-dollar equity payouts for themselves. They know for a fact that the specialized cooling infrastructure is wearing out faster than ever under the extreme thermal load of continuous generative AI processing. But instead of taking the massive financial hit, they stretch the stated useful life of the internal hardware from 5 years out to 10 years. They push the building shell depreciation schedules from 15 years out to 30 years. The paper profits look absolutely miraculous. Institutional investors pile in by the millions, completely unaware that the underlying physical asset base is quietly decaying at warp speed inside the sterile server rooms. The internal corporate conversations are highly calculated exercises in plausible deniability. The chief financial officer asks the lead auditor, "If we provide an independent engineering study claiming the lithium-ion battery backups will easily last a full decade, will you sign off on the extended depreciation schedule?" The auditor, completely desperate to retain the highly lucrative $5 million annual audit fee, responds, "As long as your internal models support the assumption, we will issue an unqualified opinion." The Big Four accounting firms function as the primary enablers of the entire bubble. They willingly rubber stamp the massive useful life extensions because the official auditing standards regarding high-density AI compute degradation are completely vague. The United States Securities and Exchange Commission has absolutely no specific accounting provisions detailing standard depreciation schedules for generative AI hardware. The regulatory loophole is completely wide open, and the executives drive a massive truck right through it. In the quiet years leading up to the absolute peak, corporate insiders at these major facility operators aggressively exercise their stock options, silently cashing out hundreds of millions of dollars in personal wealth before the completely inevitable collapse of the underlying assets. The true mechanical trick at the heart of this massive illusion relies heavily on the technical definition of adjusted funds from operations. Unlike standard net income, this is a metric specifically designed to show the actual hard cash a commercial real estate company generates. The basic formula subtracts maintenance capital expenditures directly from total funds from operations. Maintenance is the money spent strictly to keep the lights on and the servers from melting. Replacing blown cooling fans, swapping out dead power units, and fixing leaking coolant pipes. Because the new AI chips run incredibly hot, These basic operational costs are astronomical. But growth capital expenditure, which is money spent to acquire entirely new physical assets or permanently expand capacity, is not subtracted in this specific formula. So, the corporate accounting departments systematically take millions of dollars in routine repair invoices and quietly reclassify them as strategic growth investments. They disguise operational bleeding as massive strategic expansion. This accounting sleight of hand artificially inflates the cash flow metric by more than 20%. Wall Street analysts look at the heavily inflated metric, immediately upgrade the stock to a strong buy, and ignore reality. The top executives lock in their extreme generational wealth, leaving the massive deferred maintenance costs silently accumulating on the corporate balance sheet like a ticking financial time bomb. They know the internal equipment will completely fail long before the end of the newly extended 30-year useful life, but by the time the massive replacement costs finally hit the income statement, the current management team will have safely retired to private islands. The system is perfectly engineered to extract hard cash from retail investors and massive pension funds, while quietly shifting the ultimate liability onto the future balance sheet. The private credit managers have their massive origination fees. Nvidia has its $70 billion market capitalization bumps. The real estate executives have their massive performance bonuses. The entire illusion is seamless, heavily protected by layers of opaque special-purpose vehicles and rubber-stamped corporate audit reports. But financial gravity cannot be suspended indefinitely by clever accounting tricks. The mechanical truth of the rapidly decaying physical hardware is about to violently collide with the accounting fiction. The very first massive crack in the foundation is completely imminent, and it starts in Manhattan. March 20th, 2024. Exactly 8 o'clock in the morning, Eastern Standard Time. Inside the Manhattan offices of Hindenburg Research, the rhythmic clicking of mechanical keyboards echoes heavily through the room. The devastating short seller Dossier goes live on the Bloomberg terminal. Across London and New York, institutional trading desks erupt in chaos. Red alerts immediately flash across thousands of screens. The massive report meticulously dissects the great global real estate illusion. It details exactly how Equinix, the undisputed backbone of all global AI infrastructure, has been actively running a massive accounting manipulation scheme for years. Down in the Equinix executive suite, the morning coffee turns cold. Frantic messages flood the internal corporate communication channels. The public relations team desperately scrambles, but they quickly realize they cannot dispute the core mechanical truth of the massive report. The internal documents and verified whistleblower testimonies are absolutely damning. The forensic unmasking of the maintenance capital expenditure lie is now public record for the entire financial sector to read, and the immediate mathematical consequences are completely unavoidable for the entire market. The internal testimony documented in the investigative dossier leaves absolutely no room for alternative interpretation. A former high-level executive states plainly, "It looks like we are finally caught. We are actively capitalizing things that should never be capitalized under any circumstances." The short sellers reveal that the massive company misclassified approximately $3 billion in basic maintenance expenses as massive growth expenditures over a 4-year period. The market reaction is incredibly violent and absolutely immediate. In a single chaotic trading session, the stock price craters. Panic selling entirely wipes out $15.5 billion in total market capitalization before the closing bell even rings. Institutional portfolio managers, who had blindly trusted the heavily manipulated adjusted funds from operations metric, are caught entirely off guard. The phones at the major international auditing firms start ringing off the hook. Angry clients demand immediate explanations regarding the wildly inaccurate useful life depreciation schedules of their massive data center holdings. The localized collapse instantly triggers a massive wave of forensic re-evaluations across the entire global sector, exposing the massive rot. The massive collapse of the Equinix valuation is absolutely not an isolated financial event. It is the sudden and violent repricing of a massive systemic lie. When one major global player is caught actively manipulating the capital expenditure formula, the market immediately assumes every single operator in the space is running the exact same fraudulent playbook. The financial contagion spreads instantly to the highly leveraged smaller operators. Because the illusion of limitless cash flow is permanently shattered, the massive private credit markets entirely freeze up. Lenders abruptly tighten their debt covenants and demand physical on-site audits of the actual server racks. They suddenly realize they have issued 30-year debt on hardware that is literally melting under the massive thermal strain of running complex artificial intelligence models. The terrifying realization sets in that the entire net asset value of the massive sector is artificially inflated by at least 40%. The credit rating agencies, completely terrified of facing a massive repeat of the 2008 subprime mortgage crisis, quietly refuse to rate any new tranches of debt backed by AI hardware. Without the continuous flow of newly originated high-yield debt, the entire ecosystem begins to violently choke. The neocloud startups, entirely dependent on massive fresh capital injections to properly service their massive existing loans, suddenly find themselves entirely locked out of the credit markets. The round-tripping machine completely breaks down. Nvidia can no longer manufacture massive artificial demand by funneling cash into special-purpose vehicles because the massive debt funds totally refuse to participate in the middle of the loop. The localized collapse has completely morphed into a massive liquidity crisis. The startups cannot afford the massive power contracts required to keep the highly specialized servers running, and the facility operators cannot afford the massive maintenance costs to keep the specialized cooling systems functional. The theoretical duration mismatch has become a very real operational nightmare. The focus rapidly shifts from the heavily manipulated accounting ledgers in Manhattan to the actual physical construction sites in the Midwest, where the massive financial rot is loudly manifesting as completely cold steel and entirely empty concrete server halls. April 12, 2024. Ellendale, North Dakota. The previously deafening hum of massive high-voltage transformers gives way to an incredibly eerie silence inside a massive, semi-finished applied digital facility. Thick dust heavily gathers on completely empty co-location racks. Massive construction has been abruptly halted. A massive transformer explosion earlier in the year caused a highly disruptive power outage, but the electrical failure is just a massive symptom of the deeper financial cancer. The company's massive debt burden is completely crushing them. They are completely unable to secure the highly specialized power components required for massive, high-density clusters. The stock has plummeted 80%, falling rapidly from a massive peak of $1.2 billion down to under $250 million. This complete collapse happened directly after they failed to service their high-interest loans and were forcefully required to restate their earnings due to massive material weaknesses in internal corporate controls. The massive shell sits completely empty, a permanent monument to massively misallocated capital completely frozen by debt. The incredibly stressed chief executive officer is pacing the cold concrete floor, currently on the phone with aggressive, distressed debt lenders. The conversation is incredibly desperate. He actively pleads, "We have the heavy steel firmly in the ground, but without the massive power transformers, this is literally just a $100 million empty concrete tomb. We urgently need more debt to properly service the massive debt we actively used to build the shell in the first place." The massive lender on the other end of the line is entirely uncompromising. He flatly replies, "We are strictly enforcing the debt covenants. You are entirely missing your massive power purchase agreement targets, and your incredibly expensive collateral is rapidly depreciating, much faster than you can even install it. We are absolutely not throwing good money after bad. This specific, highly desperate dialogue is actively playing out across dozens of massively distressed infrastructure firms. They borrowed billions at incredibly high interest rates, entirely assuming they could generate massive immediate revenue. But the electrical bottleneck killed them before they even started. This is the brutally harsh reality of the massive duration mismatch violently snapping back. When a young startup actively takes out a massive 7-year loan, heavily backed by rapidly degrading hardware, they absolutely must generate massive cash flow in month 1. There is absolutely no grace period. If a massive power transformer suddenly blows out, or if the local utility company heavily delays the massive grid connection by 6 long months, the massive economic model instantly collapses. The incredibly expensive hardware actually loses 20% of its technological relevance while quietly sitting in a cardboard box, actively waiting for electricity. The massive debt service entirely drains the remaining cash reserves. When the massive company inevitably defaults, the aggressive lenders actively foreclose and immediately attempt to seize the massive physical assets. But secondary markets for massive data center asset-backed securities have completely frozen. Absolutely nobody wants to buy a massive warehouse full of slightly used, technologically obsolete graphics processing units. The ultimate liquidation value completely drops to absolute pennies on the dollar, destroying the credit funds. The massive financial fallout actively transitions from quiet boardroom panic to incredibly aggressive regulatory intervention. The lucrative era of totally self-regulated engineering studies and entirely rubber-stamped audit reports is officially over. Massive institutional shareholders, having painfully watched billions in equity completely vanish, actively demand immediate executive ousters. The mainstream financial media finally stops breathlessly talking about the exponential potential of generative models and actively starts looking at the incredibly toxic balance sheets of the major infrastructure providers. The corporate liquidators actively begin aggressively dismantling hundreds of millions of dollars in massive stranded assets, quietly selling off highly specialized cooling units for basic scrap metal prices. But the ultimate existential threat is absolutely no longer just incredibly angry shareholders or massively defaulted corporate loans. The massive scale of the extreme wealth destruction has directly attracted the complete attention of massive federal authorities. The comprehensive legal architecture for massive criminal prosecution is actively being laid down. The massive crisis has actively moved directly into the crosshairs of the massive federal government, and the subpoenas are being drafted. May 2024. The massive data center advisory desk at the PricewaterhouseCoopers corporate offices in London. The massive auditing teams are actively pulling back-to-back all-nighters. The massive paper shredders are absolutely not running, but the massive digital equivalent is actively happening in completely real time. Teams are actively executing extremely frantic re-evaluations of massive impairment tests for massive hyperscaler assets. The United States Securities and Exchange Commission has officially begun issuing incredibly formal subpoenas to major data center facility operators. The massive federal investigators are absolutely not asking for broad financial summaries. They are aggressively demanding the highly granular internal serial numbers, the massive maintenance logs, and the exact physical installation dates of massive battery backups and incredibly complex server clusters. The massive panic in the room is completely palpable. The terrifying realization firmly sets in that the incredibly highly paid auditing partners knowingly signed off on massive depreciation schedules that completely defied the most basic laws of basic thermodynamics. They treated rapidly decaying batteries like solid concrete blocks. An incredibly highly paid risk management consultant is currently on a highly secure line, actively advising the massive corporate board of a major mid-tier facility operator. His voice is incredibly tight with massive anxiety. He firmly warns them, if the Securities and Exchange Commission forcefully requires us to directly mark these physical, massive assets to the actual market immediately, the entire massive net asset value of the massive sector completely collapses by 40% tomorrow morning. Absolutely do not put any of this highly sensitive information in writing. The massive board members sit in completely stunned silence. Simultaneously, the United States Department of Justice and the massive Federal Trade Commission actively initiate incredibly sweeping antitrust probes directly into the massive hardware manufacturers. They are specifically aggressively targeting the highly lucrative vendor financing practices and the incredibly opaque internal allocation ledgers. The massive government investigators actively want to strictly know exactly why certain massive startups received extremely preferential treatment to corner the market. The massive round-tripping loop is finally being dismantled by aggressive federal prosecutors. The massive historical parallels are completely undeniable. This exact massive financial mechanism is a directly perfect reincarnation of the incredibly massive telecom fibre bubble of the year 2000. During the absolute peak of the massive dot-com boom, major companies like Global Crossing and WorldCom actively took on billions in extremely high-yield debt to actively lay millions of miles of extremely expensive dark fibre optic cables entirely across the massive ocean floor. They aggressively underwrote the massive debt on the absolute false assumption that global internet traffic would aggressively double every 100 days, completely indefinitely. When the actual global consumer demand massively missed those highly absurd corporate projections, the incredibly massive debt burden completely crushed the massive operators. The incredibly expensive fibre optic cables sat entirely dark and completely worthless at the very bottom of the massive ocean. Today, the extremely expensive telecom cables have simply been actively replaced by extremely expensive graphics processing clusters. The underlying massive financial crime is perfectly identical, entirely fueled by extreme executive greed and heavily compromised corporate auditors. The incredibly violent initial crash has completely wiped out billions, but the massive underlying regulatory loophole actively remains completely open. Massive private credit markets are still completely unregulated regarding internal collateral quality. The massive Securities and Exchange Commission still entirely lacks extremely specific accounting provisions for massive generative hardware depreciation. The exact, perfectly identical, massive vendor financing loop, actively utilizing massive special purpose vehicles to actively manufacture massive artificial demand, is actively being entirely replicated right now in the rapidly emerging massive humanoid robotics and massive edge computing sectors. Massive hardware manufacturers are once again actively funding their absolutely massive customer base to actively create the massive illusion of completely limitless exponential growth. The massive data center bubble was absolutely just the massive beta test. If you strongly want to actively survive the incredibly dangerous next iteration of this exact massive financial trap, you desperately need to strictly understand the massive mechanics. Subscribe to Capital Curriculum. The absolutely massive next duration mismatch is already actively being underwritten, and the massive bill is finally coming due.